Good evening, students. Welcome to the session. I hope you have revised what we had promised last time, right? Have you revised or not? Yes or no, the indirect transfer provision? Yes or no? Have you revised it? Yes. Purushottam, you have some question. In our second example, while calculating the Indian assets are held at least 50% of the total assets of company, why do not we take the total 20% of the foreign company's stake in the Indian company assets on the specified date? That is 20% of 200 crores plus 50 crores of assets held by foreign company on its own. No, Purushottam, we don't have to do it like that. We have to consider the assets which are held by the foreign company, which is the Mauritius company. And then you have to compare it with the Mauritius company asset. You don't need to compare it with the other company. Are you getting it? So what we have done in the last example, one second, let me show you. Yes. So here, if you see the total assets which are there, it is 200 CR, right? Out of this 200 CR, we are taking the 20%, which is 40 CR, right? Now 40 divided by 50 CR. 50 CR is this one. So you have to do it like this. So 50 CR, which is there, you don't need to plus it with this particular 200. This 200 is of the Indian company. This 200 is of Indian company's asset. This Mauritius company's 50 includes the investment in Indian company. So this 50 is need to be taken and not 200 plus 50. Got it? Good, Kaushiki. Okay. Now we move further towards the rest of the topics now. Now it's going to be little simpler. Okay. Now it's not going to be that difficult. The difficult part we have already crossed. Okay. Now we have done section 911. I'll just quickly recap everything what we have done so far, so as to consolidate what we have studied till now. Okay. So we started with the section 6, which is the residential status of the individual. And then finally we started with the poem. In the poem, we had seen a foreign company is resident in India only when it has a place of effective management in India. What is place of effective management? Place where the key management and commercial decisions as a whole for the entity are being taken up, right? Now for the poem, we have the guidelines of the CBDT. Now the CBDT guidelines prescribe that a company, one needs to check whether the company satisfies the ABOI test. Now what is the ABOI test? If the passive income is less than 50% of the, less than equal to 50% of the total income, what is the passive income? The income from purchase and sale to a interest, dividend, royalties, capital gain, rent, that is your passive income. And the other three conditions are that the asset test, assets in India are less than 50%, employees in India are less than 50%. Employees include not only employees employed by me directly, but personnel performing the similar operations as that of employees, right? Then the payroll expenditure on the employees who are situated or resident in India is less than 50% of the total payroll cost. Okay. If the ABOI test is satisfied, then the poem shall be presumed to be outside India if majority of the board meetings are held outside India. The exception to that is if the de facto decision-making authority of the is not with the board, but with the Indian holding or the Indian resident director. Okay, then the poem in that case shall be in India. In case the ABOI test is not satisfied, then the two questions needs to be asked. Who is making the key management commercial decisions and where are those decisions being taken up? For that, again, we have a lot of guidance which is provided by the CBDT. Fine, and the poem is not applicable for the companies having turnover less than rupees 50 crores. Okay, that was about the poem. Then we move to section 9. Section 9, which is there, is income accruing or deemed to accrue or arise. Sorry, income deemed to accrue or arise in India. Section 911 talks about the business connection, property, assets, source of income, or transfer of capital assets situated in India. Business connection is not a defined concept. Explanation 3, explanation 2, which is there, includes the dependent agency under the business connection. Who is a dependent agent? One who habitually exercises the authority to conclude contract, or habitually concludes the contract, or habitually plays the principal role leading to the conclusion of contract, or habitually secures the order for mainly or only for non-resident, or the one who habitually maintains the stock of goods and deliver therefrom. Secondly, it includes the significant economic presence. Now, what is significant economic presence? Transaction in respect of goods or services, including the provision of download of data or software, which is exceeding rupees 2 crore, where the payment exceeds rupees 2 crore, systematic and continuous soliciting of the business activities or engaging in interaction with the number of users exceeding 3 lakhs. Fine. Now, only the income which is reasonably attributable to operations carried out in India is deemed to accrue or arise in India. That will include the income from the advertisement which targets a customer resident in India or a customer who accesses Indian IP, sale of data collected from a person who resides in India or from a person who accesses Indian IP, or sale of goods or services using the data collected from the person who resides in India or uses the Indian IP. Now, as far as the transfer of capital assets situated in India, the share of a foreign company, if it derives its value substantially from the Indian assets, will be deemed to be situated in India, right? Now, when do we say that the shares of the foreign company derives the value substantially from the Indian assets? Substantially means where the value of the Indian assets as on the specified date exceeds rupees 10 crore and represents at least 50% of the value of the assets owned by the foreign company. What do we understand by the value? Value means the fair market value without the fair market value of assets, without including the liabilities, without reducing, the liabilities. Specified date means what? You have to compare the book value as on the date of the transfer. If it is exceeding the book value as on the date of the last date of the accounting period of the foreign company, if the answer is yes, then the date of transfer you have to take the FMV. If the answer is no, then the date on which the accounting period ends. Now, indirect transfer is not applicable if the capital asset is held by non-resident by way of investment in FPI, if it is redemption of the or buyback of the shares held indirectly in specified funds, foreign company does not hold at any time in 12 months preceding the date of transfer the right of management and control, and voting power or share capital is less than 5% of the total voting power or share capital. Fine. Okay. Are we clear till now? We are done this much. On Purushottam, Indian company assets purchased from state invested by the Mauritius company. Why do we take into account as if it's the assets of the company? Sorry, I didn't get your question, Purushottam. Indian company assets purchased from the state invested by the Mauritius company. No, can you elaborate your question little? Kaushiki, users mean the one who is using the particular platform or accessing the services. Let's say, for example, Facebook users, Instagram users, like that. Fine. Okay. Yes. Now, before we finish the section 9, we have to move towards the next section, which is in the context of section 9A. Now, what is section 9A? Section 9A, which is there, is the, again, in exception to the business connection definition. What is section 9A? Let's try and understand now. Section 9A is regarding the fund manager, the eligible fund manager in India. So section 9A, which is there, is exception to section 911, business connection. Section 9A, eligible fund manager not to constitute business connection. Not to constitute the business connection. Now, if let's say, for example, in the case of the eligible investment fund. Now, what is the eligible investment fund? This is given as a part of your supplementary material. So please read from that. I'll share my screen so that, we can directly do therefrom, because there are many conditions to it. Yes. See, in case of an eligible investment fund, the fund and management activity carried out through the eligible fund manager acting on behalf of such fund shall not constitute business connection in India. So if I have appointed an eligible fund manager who is acting on behalf of the fund, then that will not constitute the business connection. Now, there has to be the satisfaction of the prescribed condition. Now, what are the conditions? Conditions to be fulfilled by the eligible investment fund. The investment fund means a fund established or incorporated or registered outside India. These are like, mutual funds only. They collect the investments and they put up in the pool of assets, different assets, right? So which collect the investment funds from its member for investing it for their benefit. Further, it should fulfill the following condition. Fund should not be a person resident in India. Fund should be a resident of a country with which India has a DTL. The aggregate participation or investment in the fund, directly or indirectly by persons being resident in India, should not exceed 5% of the corpus of fund. Meaning, the Indian residents should not be holding the investment in the fund more than 5% of the corpus of fund. So the more than 5% of the corpus of fund should not be held by the Indian residents. Okay. However, for the purpose of calculation of the aggregate participation or investment in the fund, any contribution made by the eligible fund manager during the first 3 years of the operation of the fund, not exceeding rupees 25 crore, would not be taken into account. So it's saying just for the calculation of the participation or investment in the fund, the contribution by the fund manager less than 25 CR will not be considered for the purpose of determining the aggregate corpus or the aggregate participation or investment. Okay. The fund and its activity should be subject to applicable investor protection regulations in the country where it is established. Fund should have a minimum of 25 members who are directly or indirectly not connected persons. Any member of the fund, along with the connected person, shall not have any participation interest directly or indirectly in the fund exceeding 10%. So these are some conditions, that the fund should have more than 25 members, and the fund should not be owned, the corpus of the fund, more than 5% should not be owned by the Indian resident. 1% should not be owning more than 10% of the fund. The aggregate participation interest directly or indirectly of 10 or less members shall be less than 50%. So if there are 10 or less members, then the aggregate participation shall not be more than 50%. Okay. Investment by the fund in any entity shall not exceed 20% of the corpus of the fund. A fund should not have more than 20% in a single entity. No investment shall be made by the fund in its associate entity. Monthly average of the corpus of the fund shall not be less than 100 crore. If the fund has been established in the previous year, the corpus of the fund should not be less than 100 crore at the end of the period of 12 months from the date of its incorporation. However, this condition is not applicable to a fund which is wound up during the year. The fund shall not carry on or control and manage directly or indirectly any business in India. Fund should neither be engaged in any activity which constitutes a business connection in India, nor should have a person acting on its behalf whose activities constitute a business connection in India other than the activities taken by the eligible fund manager. Remuneration paid by the fund to the fund manager in respect of fund management activity undertaken on its behalf shall not be less than the amount calculated in the prescribed manner. So these are small conditions which are given. So it should be an eligible fund manager. Okay. Now, certain conditions not to apply to investment funds set up by the government or central bank of a foreign state or sovereign fund or other notified fund. So here it is saying that these conditions which are there may not be applicable in case of the investment fund which is set up by the government or the central bank of a foreign country or a sovereign fund or any other notified fund by the central government, for example, foreign portfolio investors or the AIFs. Okay. The fund should have a minimum of 25 members. So these conditions are not applicable to them. Any member of the fund along with the person connected person shall not have participation interest in the fund exceeding 10%. This condition is not applicable. The aggregate participation of 10 or less members shall be less than 50%. These three conditions are not applicable to the fund owned by the central government, central bank, or the FPIs or the sovereign fund. Now, who is the eligible fund manager? The person should not be an employee of the eligible investment fund. The person should be registered as a fund manager or investment advisor in accordance with the specified regulation. Then the person should be acting in the ordinary course of business as a fund manager. The person along with his connected person shall not be entitled to more than 20% of the profits accruing or arising to the fund from the transactions carried out by the fund through the fund manager. Are we clear? So this is what is generally provided. These are some conditions I just wanted to highlight. Main point here is that if the eligible fund is there, is being managed by the fund manager, that fund manager will not result in the business connection in India. Are we clear? Any questions so far? Any doubt? Okay. Every eligible investment fund shall, in respect of its activity in a financial year, furnish within 90 days from the end of the financial year a statement in prescribed form. The statement should contain the fulfillment of the above condition and other relevant information. If the fund fails to furnish the statement within 90 days, the income tax authority may direct the fund a penalty of rupees 5 lakh. Clear? So they have to furnish the statement that they have fulfilled these conditions. Non-applicability of special taxation regime under section 9. The special taxation regime would not have any impact on taxability of any income of the eligible investment fund, which would have been chargeable to tax irrespective of whether the activity of the eligible fund manager constituted the business connection in India or not. Further, the said regime will not have any effect on the scope of total income or determination of total income. So meaning they are saying that if any particular tax regime is applicable, that will not be affected by section 9. This is a clarification. Certain conditions not to apply or apply with modification to investment fund and fund manager if the fund manager is located in an IFSC. Now, this is the amendment which is there. So, if a fund manager is located in IFSC, there is certain relaxation. What are the relaxation? For the eligible investment fund, the only conditions which are applicable are that the fund should have minimum of 25 members. These conditions are again not applicable as they were not applicable for the FPIs, sovereign funds, or the funds owned by bank or the central government. Similarly, these conditions will not be applicable if the fund manager is located in IFSC. That the fund should have minimum of 25 members. The members should not have the participation interest exceeding 10%. 10 or less members to combine should have less than 50% interest. All these conditions are not applicable. Are we clear? Fine. Yes. So this was just the only amendment which was there. Is it clear? Yes or no? Yes or no? Is it clear? Any questions? Any doubt? Purushottam, assets held by the Indian companies, some portion of the assets bought from the investment by the Mauritius company. If that is the case, why do not we take those assets owned by the Mauritius company? Purushottam, if I understand your question correctly, you are saying that if the investment in the Indian assets is owned by the Mauritius company. Why we are not taking it as the assets owned by Mauritius company? We are taking it in the 50 crores which was there. The investment in the Indian company is already present. So we have considered that. See, the 200 crores which is there, that is the asset of the Indian company, out of which the Mauritius company's investment in its books of accounts, the Indian company's investment in the Mauritius company's books of account is included in that 50. So we don't need to again add it up to that, because those are the assets of the Indian company. Clear, Purushottam? Okay. So section 9.1 is completely, 911 is completely done. Fine. Now moving on to the next part, which is section 912 and 913. This is for the salaries. This is for the salaries, right? Income from salaries earned in India. Now, income which fall under the head salaries will be deemed to accrue or arise in India if it is deemed to accrue or arise in India if it is earned in India. Now, salary which is payable for the services rendered in India would be treated as earned in India. What do we mean by earned in India? For the services rendered in India. For the services rendered in India. Further, the salaries which are payable for the rest period or leave period, which is preceded and succeeded by the services rendered in India and form part of the service contract of employment, will also be regarded as income earned in India. Let's say, for example, I have rendered the services as an employee of the foreign company in India from 1st March to 15th March. After that, I was on leave for, let's say, 7 days. So then I was given the paid leave. So then the income from 1st March to 21st March will be considered as the income deemed to accrue or arise in India. Or the salary from 1st March to 21st March will be considered to be earned in India and would therefore be deemed to accrue or arise in India. So for the services rendered in India, this will include leave period preceded or succeeded by the period by the services rendered in India. Okay, so this is section 912. As far as, so this is with respect to the any other employer. As far as the government employer is concerned, if the government is the employer, if the salaries are payable by the government, then in that case, even in respect of the services rendered outside India, the salaries paid to a citizen of India would be deemed to accrue or arise in India. So, salaries payable to Indian citizen for service rendered outside India would be deemed to accrue or arise in India. So is it clear? So even if, let's say, for example, I'm the government employee and I have gone outside India for the purpose of rendering the services. So that will also be deemed to accrue or arise in India. Okay, but the allowances and perquisites which are there, which are paid by the government to the Indian citizens for services rendered outside India are exempt under section 10(7). So it is only the salary which is paid outside India, the actual salary, that will be deemed to accrue or arise in India. Okay, so you can write down allowances or perquisites by government to Indian citizen for services outside India exempt under section 10(7). Are we clear? Fine. So let's say, for example, I'm a citizen of India. I'm employed by the Indian embassy. Let's say I've gone to USA. Now there I receive the salary and allowances from the government of India for the services rendered in USA. Now the allowances and the perquisites will be exempt under 10(7), but the salaries which are there will be taxable in India because it will be deemed to accrue or arise in India. Fine. Any doubt till now? Any question, any doubt? Kaushiki, preceded or succeeded or preceded and succeeded, or okay, it's or preceded or succeeded. Okay. Fine. It doesn't make a difference here because preceded and succeeded, it doesn't mean that both the conditions need to be fulfilled. Here, preceded or succeeded, whatever it is, it will be included. Though the act uses the word and. Okay. But because this is not a condition, this is just the statement which is there. Fine. Okay. Next is 914. Dividend. Okay, before we go to 914, just tell me, if let's say, for example, there is a foreign company who deploys or seconds an employee to India. Now, in this particular case, this foreign company is making the payment of salary to this employee. Now, this salary for the services rendered in India will be deemed to accrue or arise in India. So this foreign company will have to deduct the TDS also. Now, TDS is under which section? You have done the TDS class. TDS under which section? Yes, Kaushiki, very good. So TDS will be under which section, others? Yes. No, Purushottam. Yes, others, very quickly. I'm waiting for your answer. Everybody needs to answer this, those who are attending the class. Yes. No, Mansha. The TDS will be under 192 and not 195. Why? What was section 195? Do you remember? You have done section 195, right? In the TDS class. What was it saying? Section 195 is applicable to payments other than salaries. Section 195 is applicable to other than salaries, isn't it? What does section 195 provide? It is applicable to other than salaries. So 195 will not be applicable over here. Also 192 covers every person. Covers every person. So here 192 will be applicable for the foreign company to deduct the TDS and not 192. Clear? Okay. Now moving further with respect to dividend. Now what for dividend, what is the deemed accrual rule? Dividend paid by an Indian company. Dividend paid by an Indian company outside India. Dividend paid by an Indian company outside India is deemed to accrue or arise in India. Okay, so even if it is paid outside India by the Indian company, that will be deemed to accrue or arise in India. Are we clear? Yes. So for dividend, it's very simple source rule that the dividend paid by the company outside India will be deemed to accrue or arise in India. Fine. Is it clear? What about the dividend paid by the foreign company whose shares derive the value substantially from the Indian assets? Dividend paid by the foreign company whose shares derive the value substantially from Indian assets. What about that dividend? Yes, Kaushiki. Very good. What about the dividend paid by a foreign company which is deriving its value substantially from Indian assets? Yes. Deemed to accrue or arise in India? Yes or no? Yes, Mansha, very good. So, dividend paid by foreign company whose shares derive the value substantially from Indian assets not deemed to accrue or arise in India. This is the CBDT circular. No, Purushottam, we discussed that day that just because the capital asset is deemed to be situated in India, the CBDT has clarified that the dividend will not be deemed to accrue or arise in India. So this is the CBDT circular we discussed in the last class. Okay. Okay. Fine. Okay. Now we are coming to the next section, which is we are going to do together interest, royalties, fees for technical service. Section 915, 6, 7. Okay, section 915, 6 and 7. Now here, this is the source rule when it is deemed to accrue or arise in India is dependent on the payer. The payee is always a non-resident, right? The one who is receiving the income is always a non-resident. But the source rule, whether it is deemed to accrue or arise in India, is dependent on the payer. For all these three, it's same. If the payer is government, then it is deemed to accrue or arise in India. If the payer is the government, then it is always deemed to accrue or arise in India. If the payer is resident, then also it is deemed to accrue or arise in India. There is an exception to this, but for the government, there is no exception. For the resident, there is an exception. What is the exception? Where it is payable, where the interest, royalties, or technical services are payable in respect of business or profession carried on outside India by the resident, or for the purpose of making or earning any income from any source outside India, then it will not be deemed to accrue or arise in India. If it is for business or profession carried on outside India, or for making or earning any income from any source outside India. Let me give you an example to understand this. So let's say, for example, if, let's say, ABC Limited is there. It is hiring a professional from, let's say, US. Or let's say that it is hiring a US lawyer. For the purpose of, let's say, a merger and acquisition in India. Now it is paying the professional fees. Now this will be deemed to accrue or arise in India. Let's say it is also paying him the professional fees for the purpose of a case pending before district court in US. A district court in US. Right? This is for a case pending before the district court in US, which was of its US business in relation to its US business and US customers or US branch. Then this will be not deemed to accrue or arise in India, because this is for the purpose of carrying out the business or profession outside India. Or let's say if this was for the mergers and acquisition to be carried out in US. So then this is for the business or profession carried on outside India. Clear? Fine. If the payer is now a non-resident, If the payer is a non-resident, then it will be deemed to accrue or arise in India. If the payer is a non-resident, then it will be deemed to accrue or arise in India. If it is for the business deemed to accrue or arise in India, if it is for business or profession carried on in India, by that non-resident, or if it is for the business or profession carried on by that non-resident in India. Fine. If it is for the business or profession carried on in India. Sorry. Okay. So let's say for an example here, let's say for example, if let's say ABC Inc. is planning to start the operations in India. For that purpose, it is hiring a consultant in US, to which it is paying the professional fee. Now this will be deemed to accrue in India. Why? Because this is for the Indian business. Are we clear? Any doubt? Any question, any doubt? Yes or no? Fine. Okay. Now, one more important thing over here. One more important point in respect of the interest, dividend, interest, fees for technical services and royalties. Now, what is the important point? Let's try and understand. See, there was one, or let me tell you an example. There are certain composite contracts. There are certain composite contracts which a company enters into. Let's say, for example, if there is a company, let's say ONGC. If ONGC is there, now it is into, all of you know that it's into the oil exploration, oil drilling, right? For all of that. Now, let's say, for example, ONGC hires a, let's say, Chinese company for the purpose of exploration of mineral oil by sending some or exporting some machinery. Right? Now, this Chinese company will first make the designs and layout before it manufactures the machinery. Then it will export the machinery. Then it will send its employee to install the machinery. Install the machinery. Right? So here, if you see, there is this offshore service which is provided, because these designs and layout will be provided from China only. This export which will take place will also take place outside India, right? Because the sale will get concluded on the Indian port. Even before it reaches the Indian port, because let's say the risk and the rewards are with the company, Indian company, and not the Chinese company, and the sale is concluded outside India. So there is offshore supply of goods, and let's say there is installation services which will be performed in India. So there is onshore supply of services, right? So this is a composite contract is entered into. A separate contract is not entered into for this, and there may be a lump sum fee or there may be a breakup of the fees which is provided. But the point is, now these two services, the services as well as the sale of goods will not be taxable in India because this is concluded outside India. The services are provided outside India. But this will be deemed to accrue or arise in India. Because for the installation charges, the resident is making the payment. So therefore, this is taxable in India very clearly. With respect to this is very clear. This is not taxable because this is concluded outside India. Now, as far as this, there was an ambiguity. The taxpayer contended that these services are rendered outside India. So this should not be taxable. The tax authorities contended that no, even though these services are rendered outside India, but these are utilized in India. So these should be taxable in India. The Supreme Court in the Ishika Vajima Harima in 2007, this is a Supreme Court ruling for the Japanese company. It favored the taxpayer that if these services are not rendered in India, they would not be deemed to accrue or arise in India. For the taxability, Supreme Court held that the services should be rendered in India, which was not in this case. The tax department was very unhappy with the Supreme Court ruling. So it did a retrospective amendment. And what is that amendment? The amendment provides that income by way of royalty, interest, FTS, which is deemed to accrue or arise in India, shall be included in the total income of a non-resident, whether or not the non-resident has rendered these services in India. So even if the non-resident has not rendered the services in India, but these services are utilized in India, it would still be deemed to accrue or arise in India. So explanation to section 9, you can write down. Explanation to section 9 provides that income, you can write that provides that interest, royalties, fees for technical services to be included in the total income, whether or not or you can write that interest, royalty, and FTS deemed to accrue or arise in India whether or not the non-resident has the residence or place of business or business connection in India. Or non-resident has rendered services in India. So whether or not non-resident has rendered the services in India, it will be taxable in India. Okay. So even if the non-resident has not rendered the services in India, that will be still taxable in India. Fine. Yes or no? Yes or no? Clear? Okay. Now we move on to each aspect of interest, royalties, and FTS. We understand each one by one. Now, what is the meaning of the term first interest? What do we understand by the interest? Now, interest means interest payable. First, we are talking about the interest. It means this is defined under 228A. Interest means interest payable in respect of any money borrowed or debt incurred including deposit or claim or similar right or obligation, and interest includes, so there is two parts to the interest definition. One, it says interest means interest payable on money borrowed or debt incurred, and includes what? Service fee, any service fees or other charge or other charges in respect of money borrowed or debt incurred, or any credit facility which has not utilized, or any credit facility which is not utilized. Fine. So therefore, the interest will include even the service charges or processing fees. Fine. Now, one more point with respect to the interest. Kaushiki, does this explanation require if payment is for business or profession? Should it be carried inside India? No. This explanation does not require any kind of business connection. That is what it's clarifying. That even if there is no business connection, residence, place of business of a non-resident, still FTS, interest or royalties will be deemed to accrue or arise in India. Fine? Okay. Now, one more point with respect to the interest. What does it say? Now, interest, if it is payable by, let's say, there is Citibank, US. It has the branch in India. Now, it has given the loan to its branch, and the branch is paying the interest. Now, all of us knows account very well, right? CPT, IPCC, branch accounting, right? What do you do with the branch? Branch is included in the books of the parent company. A branch is not a person, isn't it? Branch is not a person. So it is like loan to self only. This is a separate entity for the purpose of doing the business, but this is not a person. Even under Income Tax Act, this is not a person. This will be consolidated with the head office only, right? Branch accounts, very basic. Now this is interest to self only. I'm giving the, or I'm putting money from my one pocket to another pocket. So there was this kind of ambiguity because here there are two countries which are involved. There are two tax laws which are involved. There is treaty which is getting involved. The question arose that whether the interest will be allowed as a deduction to the branch and will be included as the income of the US company. So CBDT has clarified that, and then this is also part of the section 911. An explanation has been introduced. What does the explanation provide? So explanation to section 915 provides that in case of a non-resident engaged in banking business, a non-resident engaged in banking business, interest payable by the permanent establishment shall be deemed to accrue or arise in India, shall be deemed to accrue or arise in India. Are we clear? So this particular interest will be deemed to accrue or arise in section 915. So therefore, the P will have to deduct the TDS on this interest paid. TDS has to be deducted by the P. Because if the P is not deducting the TDS, the P will also not be allowed as the deduction of interest. So this interest is allowed as deduction to the P. The P is deemed to be a person. P deemed to be person which is separate and independent from the non-resident. From non-resident, and interest deduction will be allowed to the permanent establishment. Are we clear? Any doubt? Fine. So interest part is clear. Yes or no? Interest part is clear. Okay. Now we are moving towards the next part, which is the royalties. See, all these can come as a part of MCQ, right? So please be very careful. You do not have to skip these small points, okay? Royalty source rule, we are very clear. There is no question about it. Fine. Now the meaning of the royalty. The meaning of the royalty is very, very important. Now the royalty means what? Royalty means the consideration including any lump sum consideration but excluding the income under the head capital gains. So royalties means consideration including any lump sum consideration but excluding income under the head capital gains. So consideration for what? Transfer of all or any rights, including the granting of license in respect of patent, invention, model, design, secret formula, process, trademark, or similar property. Fine. So transfer of all or any rights in respect of these particular intangibles. If there is entire patent which is transferred, then it will be income under the head capital gains. Fine. This is a right which is transferred. Second, use of. So I'm transferring, in the first case, I'm transferring the rights in the patent, or I'm giving the license to use my patent or my trademark, what is done under the franchise agreement, right? So that is considered as royalties. Second is use of any patent, invention, model, design, secret formula, process, or trademark or similar property. So first is transfer of, one second. Give me a minute. Yes. So the first is the transfer of the right, design, transfer of all or any right. Second is the use of. If I'm allowing the use of my patent or invention or model, I'm not transferring any right therein. You're not given any right to exploit that, but you're just given a right to use. Only you are allowed to use that. You're not allowed to sublet it, or you do not have any rights in it. So second is the use of that. Third, transfer of, third is imparting of any information concerning the working of or use of patent, invention, model, design, secret formula, or process. So first one was the transfer of the rights. Second one is the use of. And third one is the imparting of any information. So what is the difference between the three? Let's say the example for the first is, let's say the AstraZeneca or the Oxford had developed the COVID vaccine. Then it was patented. Then the patent of that, or the rights were given, the formula was shared to use, the rights were given to use that formula in the COVID shield, which was developed in India. So what the Poonawalla company used to pay, right? to that Oxford company, that was royalty. So there was a transfer of rights to use that formula, a secret formula. Right? That's the first example. Second is, I'm not giving you anything. I'm entering into a franchise agreement. I'm giving you just the patent usage. You are allowed to use the brand. You're allowed to use the design of McDonald's. That is the use of. Again, what I'm paying to you is royalty. Now, let's say third. Let's say for the COVID shield, the vaccine which was to be developed. The Indian company did not have information about how to use that formula into the vaccine development. So imparting of any information concerning the working of or use of any formula or invention or patent, the payment which is being made for that is also the royalties. Clear? Next. Imparting of, or first you can write down use or right to use. Use or right to use any industrial, commercial, or scientific equipment. Okay, industrial, commercial, or scientific equipment. So if I'm allowed to use any industrial, commercial, or scientific equipment, let's say any kind of machinery which is there, any kind of plants which are there, which are developed, any kind of commercial equipments which are there. So use or right to use that, that is also a royalty. Next one. Imparting of any information concerning technical, industrial, commercial, or scientific knowledge, experience, or skill. So any information concerning technical, industrial, commercial, scientific knowledge, experience, or skill, that is also royalty. Fine. Last one. Transfer of all or any rights in respect of any copyright, literary, artistic, or scientific work. So just like we had patent, any transfer of all or any rights in respect of copyright, literary, artistic, scientific work, including for the films or videotapes for use in connection with TV. For use in connection with TV. Or for radio broadcasting. Okay. Fine. Now, here there are 2-3 important things which we should discuss so far. Very, very important. One is, here it says transfer of right in respect of any copyright. Now there are these computer softwares which are being sold. Right? The computer softwares which are being sold. There are 2 kinds of computer software. One is the customized And the second one is shrink wrap or off the shelf. Now, computer software which are there, there are these customized software, and second are shrink wrapped or off the shelf. Meaning these off the shelf ones which are there, you can just buy it in CD. For example, your Tally ERP9. You are not allowed any customization, right? Into that, you are buying the Tally as it is. MS Office package. These are the example of shrink wrap or off the shelf. Customized means the ERPs which are customized or the softwares which are customized for a particular organization. Fine. Now, with respect to these shrink wrap software which are there, these are generally considered as sale of goods. These are generally considered as sale of goods because you are not allowed any modification into that. You cannot make a resale of that, right? So there are restrictions and you are given only a limited right to use. So if you ever read the agreement, terms of use, when you buy this MS Office or even when you start your PC with Windows, there are certain terms and conditions. Read that very carefully. There is a limited right to use which is given to the user for the purpose of using and downloading and using that software in its system. Now, the income tax authorities started contending that these kind of software, customized software, yes, that could obviously be resulting into royalty because a copyright is given for that. But in case of the shrink wrap software, there also the income tax authorities started contending that there is the royalty component. So therefore, they had amended section 916 by introducing the explanation that explanation to section 916 that transfer of all or any rights in respect of any right, property or information right, in respect of any right, property or information here itself. Transfer of all or any rights, right, in respect of any property, right or information will include the right to use or transfer of any right to use or right to use computer software, including the granting of license. Including the granting of license, irrespective of medium through which such right is transferred. So, what did the explanation provided? That the computer software, any rights transferred or right to use for the computer software will be included in the definition of royalty, irrespective of the medium through which it is transferred. Even if you purchase it as a CD or through a pen drive, it will be included as the royalty. The payment for that will be considered as royalty. And therefore, that will be covered as the royalty under section 915. This is what was clarified. But especially when we have the tax treaties, the tax treaties do not include the computer software. The DTAAs also have the royalty article. DTAAs also have an article on royalty. There, in almost every DTAA, the royalty definition does not include the computer software. This is only provided in the Income Tax Act. And as per section 90, which is what we are going to see, the provisions of the Act or the DTAA, whichever is beneficial, will be applicable. Now, the DTAA does not include the computer software within the definition of royalties. The taxpayers were arguing that will not, the payment for the purchase of computer software will not be considered as royalty. But the income tax authorities started importing the definition under the Act into the tax treaty, which matter reached to the Supreme Court. And Supreme Court in landmark case of engineering analysis. Engineering analysis center of excellence case decided upon this particular matter, whether the amount paid by the end users, or the distributors to the non-resident software manufacturers, whether that will be considered as payment of royalty. Okay, so this is what was decided by the Supreme Court. So if you see, there are end user license agreements which are entered into. End user license agreement. So whenever you go to Play Store, App Store, you find these end user license agreement, where a limited right to use is given to you to just download that particular software on your system for the purpose of using it for your own self. Even in case of distributors, the distributors are just distributing it directly without making any modification to the software. So therefore, the Supreme Court observed that the explanation to section 916 includes the computer software. Because there is a specific explanation now which is provided, which provides that the transfer of any rights or a right to use a computer software, including the granting of a license, will be considered as royalty. But under the DTAA, the royalty just means that consideration for the use or right to use any copyright. That's it. In all the DTAAs, the computer software is not specifically included in royalty. So the Supreme Court observed that in case of the distribution of software, or if the end user is directly buying it, so these distribution agreements or end user license agreement do not create any interest or give any right to the distributors or the end users, which could tantamount to the use or right to use any copyright in the computer software. So the income tax authorities were trying to import under the copyright the computer software. So the Supreme Court said, where computer software is purchased directly by end user, is purchased directly by end user, or where the Indian companies are acting as resellers or distributors. Act as reseller or distributor and purchase and resell to the end users, who purchase and resell to Indian resident end users, or where the distributors are even a non-resident who purchase from the non-resident and resell the same to the Indian resident or end users. So non-resident reseller or distributor who purchase or resell to Indian distributor or end user, or where the software is embedded in the hardware and the hardware itself is sold. Software embedded in hardware. Let's say there is chip, or let's say there is entire PC which is sold, in which the Windows is embedded into it. So in these cases, the amount which is paid by the distributors or the end users to the non-resident computer software manufacturer or supplier is not royalty. These are the business income. This is not royalty for the use of copyright in the computer software. So this is not used for copyright in computer software, therefore not royalty. This is not royalty. Okay. So therefore, the provisions which are contained in the Act are less beneficial as compared to the treaty. So therefore, the provisions which are beneficial under the treaty will be applicable to these kind of taxpayers. Okay. Is it clear? Yes or no? Any doubt? So the provisions of the Act or the treaty, whichever is beneficial, apply to the assessee. Clear? Purushottam, what about the free downloads available in the web? Again, free downloads, whatever you are, first of all, there is no consideration. So there is no question of royalty or not. First thing, even if, let's say, for example, you're downloading from web, again, what you're getting is limited right to use. You're not given any right to modify the product. So you do not have any right in that particular product. You are only having the limited right to use. Let's say, for example, when I'm buying the book, I have only limited right to read that book. Do I have the right to make the modifications and print the book again? Answer is no. If that be the case, then I have the right. I have received the patent. I have received the copyright in the literary or artistic work. That is something different. But if I'm just buying a book, is it a sale of goods or is it royalty? It's sale of goods. Similarly, when you are coming into the electronic form, you are saying it is royalty. Just because I'm buying a product, which is a computer software, I do not have any right inside that. I have just a limited right to download it on the system and use it for my purpose. Are we clear? Kaushiki, yes, I'll repeat the interest part again after royalties. Fine. Okay. Shall we take a small break over here and then we get back? Let's take a small break of 10 minutes and then we get back. Yes, there are some questions. Viraj, have you joined in now? Invoking of bank guarantees by the bank, which is drawn from cash credit of the user. Any charges collected by the bank is business income to the bank or interest income. Purushottam, invoking of bank guarantees by the bank, that is the business income to the bank. But as far as the TDS provision is concerned, these bank guarantees would not be included in the interest component, because that is not a credit facility. Yes, if it is in the nature of the cash credit, then in that particular case, the charges would be considered as interest. But the bank guarantees are not interest. The charges for the bank guarantees are not on the debt borrowed or money borrowed, which is there, right? Okay. Okay, fine. Shall we proceed further then? Yes. Now, again, under the royalty, I'll just proceed further. Now, as far as the definition of royalty is concerned, the Computer Software Supreme Court has held that it is included, though it is included in the definition of the Act, but it will not be covered in the tax treaty definition, which is there. Number one. Number 2 point, which I would like to highlight here is, there was a CBDT circular or notification, basically not a circular. There is a CG notification. A central government notification is there. Which is with respect to the TDS, right? Which is with respect to the TDS, which is there under 194J. Now, if let's say, for example, where let's say the software is acquired from a resident reseller, software purchase from the resident reseller, then in this particular case, the central government has notified that there will not be any TDS under section 194J if the software which was acquired is a subsequent transfer, meaning even this reseller had acquired the software from the manufacturer and then had made the resell to the final customer. This resident reseller has deducted the TDS under section 194J or under 195, and this particular user obtains the declaration in this regard, that the tax has been deducted, and he obtains the PAN of the reseller. TDS is deducted along with PAN of reseller. Fine. So this is the central government notification which is there, which I just wanted to highlight to you. Fine. Next important thing under royalty. Now, if you see here, the royalty includes the transfer of all or any rights in respect of the patent, invention, model, design, secret, formula, or process. Now, with respect to the process, again, there were certain questions which were arising, or there was certain litigation which was happening. Now, the litigation which was there was in the context of satellite transmission. Satellite transmission. Now, what is the satellite transmission? Do you know how do you see your programs on or live match on the television. On ESPN, you see the live match, or on Star Sports, you see the live match. How do you see that? Anyone knows about it? Yes, do you know about it? Yes or no? Do you know how satellites operate? Yes. How do you see on your channel? When you see T20 cricket, at that time you don't think, right? These are the questions you should ask yourself. Everything has tax angle. You are watching reels on Instagram, ask yourself, what is the tax implication? You're watching sports on TV, ask yourself, what are the tax implications on this transaction? How's the taxation functioning for these companies? Nobody knows? You just watch cricket. You don't think about this, right? Start thinking about it. Now you're in CA final, you're going to become CA. So let's say this is cricket, which is being played at the stadium, right? There, the cameraman will capture this. It will then send the signals. This broadcast will be sent, right? There is a satellite which is operating. Nowadays, you have Tata Sky, Dish TV, you have satellites of this. Earlier, we used to have the cable operators. Now, this satellite will receive the signals and will throw the signals on your TV, on your TV operator, whosoever is there, Tata Sky or Dish TV, whatever, right? So this satellite which is there is a satellite operator which is operating this satellite in the space, in the airspace. Now the question which arises is that whether the payments which are being made by the TV channel, let's say Star Sports, will be royalties. So the courts had answered that no, this is not royalty. This payment is not royalty, because for saying that something is royalty, some payment is royalty, I should have a right to use the equipment. It should be under my control. Let's say when I'm saying, see, royalties is something what lease, right? So you pay your rental for your house property also. That is also kind of royalty, but this is for immovable property. This is for intangible property. So if it is for immovable property, you call it rent. If it is for intangible, you call it royalty. Nature is same. When I say I'm paying rent, I have the control of that property. I'm able to use that particular premises. Here, I'm not able to use the satellite. It is not in my possession. It is not in my control. Isn't it? So the courts had answered that no, this is not royalty. This payment is not at all royalty. I should have the control of the equipment. But again, the income tax department was not happy with the court's judgment. So what they did is introduce the explanation retrospectively. What is the explanation? They have defined the term process. They have defined the term process. Process includes and shall be deemed to have always included. You don't know, you didn't know at that time that it includes this, but it was deemed to have been always included. That is your problem. What you interpreted is your problem. The process definition is amended now retrospectively. It will be deemed to have always included. Transmission by satellite, including uplinking, amplification, conversion, downlinking. Of any signal. Cable, optic fiber, or similar technology. Whether or not process is secret, because in the definition of royalty, the process, besides that, the word used is secret formula or process. So the taxpayers were contending that even the process should be secret, but here they said it whether or not the process is secret. So here even your internet charges will get covered. If you observe here, it says cable, optic fiber, similar technology. So transmission by optic fiber, your internet charges will also get covered. Even in the case when you are paying the internet charges to a resident, you will not be paying internet charges to a non-resident. Obviously, there are no non-resident service providers who are providing you the internet in India. You would be obviously paying the internet charges to Tata Sky, Airtel broadband, right? If it exceeds 30,000, you will have to deduct TDS under 194J. Royalties. That says so. Fine. Also, one more explanation was introduced. The royalties includes and have always included, meaning again retrospective amendment, consideration in respect of any right, property, or information whether or not possession or control of such right or property or information is with payer, such right, property, or information is used directly by payer, location of such right, property, or information is in India. So whether or not I have the control or possession of that particular property, it will still be considered as royalty. Whether or not I am able to use that directly, it will still be considered royalty. Whether or not the location of that satellite is in India, satellite may be located anywhere, it will still be considered as royalty. Clear? Any questions, any doubts so far? Purushottam, Instagram reels are not taxable. I had answered to you last time only in the last class that the data which is collected from your Instagram reels, what you are watching, that data is being sold, and that is how Instagram monetizes. So that is something which is taxable. Not Instagram reel is taxable. Okay. One more thing over here before we conclude on the royalty. A similar example. Do you know that when I go outside India, I cannot use the same network? Is Airtel available in USA? Do you know that? Okay, just tell me one thing. Do you know about the roaming charges? What are roaming charges? Yes. What are roaming charges? Do you know about it? Yes, I'm asking you. Roaming charges, you don't know? Okay. See, when we go outside India, our same network does not support. I will not have access to Airtel. Yes, Viraj, moving from one network to another. So Airtel will not be supported. Let's say I'm going to Europe, Airtel will not be supported. Then Airtel will tie up with the local service provider in Europe, which will get automatically connected there. So I will be still receiving calls on my Airtel. But when I'll be picking up that call, so Airtel has tied up with the local service provider. Let's say if I'm in Dubai, there is this network provider called Etisalat. So if I'm going to other country, no, Purushottam, there are no charges collected for use of SIM in the other country. SIM I'm using of Airtel only. But the service provider will change there. So now this particular Airtel, let's say I'm Indian. I'm going to, let's say, Dubai. I'm the Airtel user. Now I'm going to Dubai. There, I'll be automatically connected to Etisalat. Now, if I'm in Dubai, I'll be automatically connected to Etisalat. So therefore, in that particular situation, the Airtel would be paying something to Etisalat. Right? Something to Etisalat. So, when let's say, for example, I am going to Dubai, then I'm being used in the local network provider there. Now, SIM card remains the same. SIM card remains the same, right? So therefore, the Airtel is paying some charges to Etisalat. Right? So in that particular case, okay, I've written the spelling wrong over here. It is Etisalat. Right? So Airtel will pay some charges to Etisalat. Right? Now, when I'm getting the call, it will be connected from India to Dubai. So Dubai will, this Etisalat company will allow me to take the call which is coming on my Airtel number. For that, Airtel is paying the charges, isn't it? Now, this is possible because of the transponders which are there. Transponders which are installed there, right? So in that particular case, the question which arises whether this will be considered as royalties, whether these charges are considered as royalties. So if you see this particular explanation, it says, in this particular case, the Airtel will argue that I do not have the possession or control of any equipment. I am not using this. The user of Airtel is using this particular equipment. The location of this equipment is also not in India. But if you read this explanation, whether or not the possession is with the Airtel, whether or not the Airtel is using this particular property, or whether or not the location is in India, this will be considered as royalties. So this payment will classify as royalties. Are we clear? Yes. Purushottam, is it clear? As per this explanation, this will be considered as royalties. Fine? Okay. Now we move on to the next one. Fees for technical services. FTS. Last one. The fees for technical services. Now, fees for technical services means what? Fees for technical services mean what? It means consideration. It means consideration, including the lump sum consideration for rendering of managerial, technical, or consultancy services. Managerial, technical, or consultancy services. But it excludes, it does not include consideration for any construction, assembly, mining undertaking, right? Or consideration which is chargeable under the head salaries. Consideration which is chargeable under the head salaries. Fine. So now what is this managerial, technical, or consultancy services? What do we understand by managerial, technical, or consultancy services? This particular term is not defined. The managerial, technical, consultancy services are not defined under the Act. So several judicial precedents have been laying out what is the meaning of managerial, technical, or consultancy services, right? It is not defined very well within the Act. So what is managerial? Managerial means that kind of the management function where you are performing. Payment to the board of directors who are not the full-time directors. That is something managerial. What is consultancy? If I am providing you some consultancy services in the nature of giving you the advisory, giving you the opinions, then that is consultancy service. Now, how about the technical service? That's where the maximum litigation lies. Managerial and consultancy is very easy to discern. But what about the technical? For that, there are many decisions which we are going to discuss now. Number one. There is a decision in the case of SkyCell Communications Limited, wherein Madras High Court had held that mere collection of fee for standard facility is not technical service. So a standard facility is not the technical service. A standard facility is not technical service. It should be a customized service. It should not be a standard facility. Let's say, for example, I'm buying SIM cards. Is it a technical service? No. Let's say, for example, if the stockbrokers are paying the brokerage charges on the BSE or NSE, this is not a technical service. This is a standard facility which is provided to everybody. So that is something which is not a technical service. If a standard facility is provided, which does not involve any technical expertise, internet charges, these are again the standard facility and not technical service. So you can write down payment of internet charges, stock market, brokerage. These are all the standard facility and not technical service. Fine. Another issue which arose in the context of technical service was that the charges which are paid to the mobile operator, whether that is a technical service. So Supreme Court in the Bharti Airtel case, in the case of Bharti Cellular Limited, Supreme Court answered that the term technical derive its color from the neighboring term managerial and consultancy, the principle of adjustum de generis. The principle of adjustum generis. That the term technical derive its color from the neighboring term. It held that managerial and consultancy involves some human involvement. If there is no human involvement, that cannot qualify as technical service. So, human involvement is required to qualify a payment as technical service. Charges paid to mobile operator cannot be regarded as technical service. Fine. Another important decision in the context of AP Molar Maersk. Again, a latest Supreme Court ruling. In this particular case, the assessee was a foreign company who was engaged in the shipping business. Right? Assessee was a foreign company engaged in the shipping business. Now it hired some agents all across the globe who used to book the cargo and acted as a clearing agents for this foreign company. Now, there were 3 agents which were hired in India also for this purpose. Now, the assessee had set up a system, and this system basically was a communication system called as Maersk, where all the agents could communicate with each other based on this system. Now, the assessee used to charge the amount for this system to the agents. For using this system, the assessee was charging the amount to the agents. So the assessee had developed the system. Now the assessee was recovering the cost of that system from the agents by charging them certain fee. So the question was whether the charges which are paid by the agents to the assessee for using the system is technical service or not? Is fees for technical service or not? The AO said, yes, this is a fees for technical service. But the Supreme Court said that, look, this particular system was the communication system for the business of the assessee, with which the agents could communicate with the assessee and with the other agents. Here, the assessee had developed this system and assessee was recovering the cost of this system from the agents. It was kind of a reimbursement of expenditure. It was only a facility that was allowed to be shared with the agents and not a technical service. So, in this SkyCell or in Kotak Securities case, there also it was held that these brokerage charges charged to the stock market dealer is just a use of standard facility and not the technical service. Here also the Supreme Court held that amount paid by agents for use of communication system developed by non-resident assessee is use of facility and not technical services. The technical services denote specialized services. Clear? Any doubt? Any question? Yes or no? Is it clear? Are we clear up to this? So interest, royalties, fees for technical services, all three done. Any question? Now, what are the tax rates for the interest, royalties, and fees for technical services? What is the tax rate? Let's see. So, interest, royalties, or FTS, I'm putting it together. And I'll also put it, let's say, dividend. This is provided under section 115A. Tax rates are provided under 115A. With respect to the dividend, it is 20%. Dividend is at the rate of 20%. Fine. Interest, which is there, again, that is taxed at the rate of, there are different rates which are there for the interest. If it is interest received from the government, or Indian concern, or on monies borrowed or debt incurred by the government or Indian concern in foreign currency. Debt borrowed in foreign currency. Right? If this is the nature of interest, then it is 20%. If it is interest received from infrastructure debt fund, received from infrastructure debt fund. If it is an interest received from infrastructure debt fund, then it is 5%. If it is interest which is referred to in 194 LC, what is 194 LC? Where interest is payable to a non-resident or to a foreign company or a business trust by an Indian company, right? If the money is borrowed in the foreign currency, so interest is payable to a non-resident or a foreign company or a business trust, right? And this is in respect of if money borrowed is in foreign currency from a source outside India. From a source outside India, which is by way of long-term infrastructure bonds or under any loan agreement, right? Under any loan agreement or long-term infrastructure bond. Under loan agreement, long-term infra bond, rupee denominated bond. Rupee denominated bond, right? Then in that particular case, this is covered under 194 LC. This is covered under 194 LC and this will be at the rate of 5%. This will be at the rate of 5%. Secondly, if it is interest which is covered, if it is interest which is covered under 194 LD, if it is interest which is covered under 194 LD, what is 194 LD about? Where the interest which is paid on rupee denominated bond or government security to foreign portfolio investor. To the foreign portfolio investor, then again this is under 194 LD. This is again at the rate of 5%. This is again at the rate of 5%. Okay. Is it fine? Yes. Yes or no? And if it is interest which is distributed by a business trust to its unit holder, one second. Give me a minute. Okay. Interest distributed by a business trust to unit holder. This is under 194 LBA. This is under 194 LBA. Right? Again, that is at what rate? At the rate of 5%. That is also again at the rate of 5%. So, is it clear about the interest? Under 194 LBA, it is again at the rate of 5%. Clear? So this is about the interest and dividend. Now, as far as royalties and FTS is concerned, again here, two things need to be considered. Whether it is effectively connected to permanent establishment and not effectively connected to P. If it is effectively connected to P, then the taxability will be under section 44DA, which is on net basis. And the tax will be at the rate of 40% as applicable to foreign company. If it is not effectively connected to P, then 10% on gross basis. Then 10% on the gross basis. Are we clear? Then 10% on the gross basis. So in that case, it will not be allowed any deduction of income, deduction against the income, no tax assessing deduction will be allowed. Clear? Are we clear? Yes or no? Any questions? Constitutive Supreme Court judgment is for the off-the-shelf, not customized. Customized have some rights in it, and then that will not be applicable. Yes. Is it clear? The tax is clear. Fine. Yes or no? Okay. Now one more point with respect to 115A. Filing of return of income. Now, it is not necessarily for the assessee to furnish the return of income. Not required under section 139(1). This is exemption under section 115A. If his total income consists of the income which is in the nature of dividend, interest, or royalties, or FTS. If total income includes dividend, interest, royalties, or fees for technical services. Right? And the TDS has been deducted from such income at the rates given under this particular 115A. And TDS is deducted at rates under section 115A. So then the foreign company or a non-resident is exempted from filing the return of income under 139(1). This is very, very important for MCQs. So do remember this particular point. Purushottam, right means yes, I should have some amount of control, but the explanation which is introduced under the royalties clearly provide that even if there is no control, it will still be included in the definition of royalty. Fine? Yes or no? Is it clear till now? So we We are done entirely with section 911, 912, 3, 4, 5, 6. Last section 918. Section 918. Sum of money paid by a resident Indian. Paid by resident Indian to a non-resident or foreign company. So income arising outside India. Income is arising outside India, which is sum of money paid without consideration by an Indian person to a non-resident or foreign company deemed to accrue or arise in India. Deemed to accrue or arise in India if the same is chargeable to tax under 56(2)(10), and that is exceeding rupees 50,000. It's chargeable to tax under section 56(2)(10). So if sum of money is paid outside India, then it is deemed to accrue or arise in India. Any sum of money which is paid outside India by a resident Indian to a non-resident or foreign company, because it used to so happen that these Indians used to go out, transfer some money and make it tax-free. So that is why this particular provision was brought in. The gift of movable property or any other immovable property, that is not covered over here. That is not covered over here. That is any which way is covered when there is a transfer of a capital asset. So that is covered for the transfer of a capital asset, but not from the recipient perspective. So when I say that there is a transfer of a capital asset, that is covered from the perspective of the transferor. From the recipient perspective, that is not covered. Only the sum of money which is there, which is given to the non-resident or a foreign company by a resident, that is only covered over here. Are we clear? Yes or no? Any doubt? It's raining this month. Kaushiki, total income includes only this particular thing, no other thing. Yes, Mukta, these are the flat rates, but you need to add surcharge or education cess to this. We need to add it. Here, the education cess and surcharge will be added. Plus education cess and surcharge. Is my voice very clear? Because I think some students are experiencing a problem with the voice. Can you just confirm to me in the chat box if it's okay? I think maybe the network connection is weak because it's raining out. That's what I said, that's raining this month. It's clear, Kaushiki? Yes, okay. Okay, Viraj, perfect. Okay, so this is what we are done with the entire deemed accrual concept. Fine. Now, there is a question in your module, which is illustration 4. I would want you to solve yourself and we can discuss in the next class. So that is what something you will have to solve. Okay. Now I'll quickly share the module with you because we have to discuss the exempt income. Okay. Exempt income of non-resident. Now, these are certain exempt income which you have to remember. Interest on money standing to the credit of the individual in NRE account. What is NRE account? NRE account is non-resident external account, where you park your external income, you send it or remit it in India in the non-resident external account, hence the name. Okay. So there are two types of account in the FEMA: non-resident ordinary, which is your normal saving bank account. This is also saving bank, but this is to remit your income from outside India. This is non-resident external account, right? Now, if an individual receives any interest on the non-resident external account, on the NRE account, that is considered as exempt. If a person is resident outside India as per FEMA, not as per income tax. The definition of residency is different in FEMA and income tax. I hope you know that. FEMA laws, I'm not taking it, but the definition is different. Under FEMA, it is based on the intention of your stay. Under income tax, there is no intention. It is based on the number of days of stay. Under FEMA, if you are coming for employment, for business, you become resident. If you go outside India for employment, for business, you become non-resident. So you have to be resident outside India as per FEMA. You have to be a FEMA non-resident to claim the exemption of interest on NRE account and not income tax non-resident. Okay. So that is one exemption which is there. Second, income of specified fund on transfer of certain asset under 10.4D. Now here there is some amendment which has been introduced, which is what we are going to discuss very briefly, because this is something which is a very technical concept in its way. So let me again show you the amended section itself from your supplementary material. I hope my voice and all is audible now also. In case it goes, please let me know, because I think there is some this light electricity fluctuation which is going on because of the rainfall and thunders which are happening. So just let me know in case wherever the voice goes. Okay. So income accruing or arising to or received by the specified fund would be exempt. Any income from transfer of a capital asset, being a bond of an Indian company or a public sector company. So income from transfer of a capital asset, being a bond of Indian company. So if I transfer the bond of Indian company or a public sector company sold by the government and purchased by the specified fund in foreign currency, then that income is considered as exempt. That income is considered as exempt. Okay. So income from the transfer of bond of Indian company or public sector company or global depository receipt or rupee denominated bond of an Indian company or derivative on a recognized stock exchange located in an IFSC and where the consideration is in foreign currency. So if the GDR, rupee denominated bond of an Indian company, is transferred on IFSC, that is exempt. Income from transfer of securities other than the shares in a company resident in India. So income from transfer of securities which are not the Indian company's shares. Any income from securities issued by a non-resident, not being a PE of a non-resident, and where such income do not accrue or arise in India. So income from the securities issued by the non-resident. Any income from securitization trust which is chargeable under the head PGBP. These are only exempt for the specified fund, not for everybody else. To the extent such income accrued or arising to or is received is attributable to a units held by non-resident or is attributable to the investment division of offshore banking unit, as the case may be computed in the prescribed manner. Now, manner of the computation of exempt income of the specified fund which is attributable to units held by non-resident is given under Rule 21 AI. How it is to be calculated? A into C1 plus B into C2 plus D into F1 plus E into F2. Very complex. Let's try and understand what is it. So A, they have said it is income accruing or arising to or received by the specified fund as a result of transfer of capital asset, which is the global depository receipt or the derivatives or the rupee denominated bond, right? On a recognized stock exchange located in IFSC. And the consideration is in foreign currency, right? So that is your A. A is your capital gain basically, right? On rupee denominated bond or on the global depository receipt or the bonds of the Indian company, which are notified by the central government. B is, so A into C1. C1 is the ratio of the aggregate of daily assets under management of specified fund which are held by the non-resident holders to the aggregate of the daily total assets under management. So asset under management held by non-resident divided by the total assets under management from the date of acquisition to the date of transfer. B is income accruing or arising to or received by the specified fund as a result of transfer of securities. So as I said here, many incomes are covered. A is the first category. B is the second category. B into C2. For C2, again, you have to take the ratio of the assets under management held by non-resident unit holder to the total assets under management. Then again, D is, third is D. D is income accruing or arising or received by the specified fund from securities issued by a non-resident and where such income does not accrue or arise in India. Again, you multiply D with the F1. Now, what is F1? F1 is again the ratio of the assets which are held by the non-resident unit holders to the total assets under management held by the specified fund. E is the income accruing or arising from the securitization trust into F2. F2 is again the same ratio. This is how you compute the income which is exempt. Okay. So the assets under management means the closing balance of the value of assets or investments of the specified fund. Fine. So this income attributable to units held by non-resident, not being a P in a specified fund, would not be exempt under 10D unless the specified fund furnishes the annual statement of exempt income on or before the date of filing of return of income. Now then they have given the manner of computation of exempt income of specified fund which is attributable to the investment division of an offshore banking unit. This is only for the banking unit they have given. Here they have said A plus B plus C plus D. Now A is your income from the capital gain from the GDRs, from the rupee denominated bond, from the derivatives. That B is your income which is there on the transfer of security. C which is there on the securities which are held by the non-resident other than the Indian shares. And D is the securitization trust income. Fine. So this is how you have to consider it. Clear? Are we clear? So this is just a small amendment which is made under the, these rules are basically notified. Now let's understand what are the securities and what is the specified fund. Securities are shares other than the shares of the Indian company, right? Derivatives, units, security receipt, government securities. And specified fund means what? A fund established or incorporated India in the form of trust or company or LLP, which has been awarded a certificate of registration as category 3 AIF, which is located in IFSC, and of which all the units are held by non-resident other than units held by sponsor or manager. Clear? This condition would not apply where the unit holders being non-resident during the previous year when such units were issued become resident under section 6(1) or 1A in any previous year if the aggregate value and the units held by such resident do not exceed 5%. Clear? So this is what they have provided for. Are we clear? Any doubt? Are we clear? Any questions? Any doubt? So this is what you have to just briefly understand, that this is the income which is exempt. Okay. Also here they have given a CBDT notification which has specified the following condition, that the unit holder of the specified fund other than the sponsor or manager who has become the resident during the previous year in which the such units or units were issued shall cease to be a unit holder within 3 months, and the specified fund will maintain the following documents. So this is just the compliance condition which is being put up for these particular funds. Okay. So they have to maintain the accounts, they have to get it audited. All of these conditions are just provided. Fine. Any doubt, any question? Any doubt? Okay. Fine. Now, what are the other category of the exempt income? Let's see. 10(4)(c) is interest income of a non-corporate, non-resident or foreign company on offshore rupee-denominated bonds issued by Indian company or business trust. This was till 31st March 19, so this is not relevant. 10(4)(c) is not relevant. Then we have 10(4)(e), income of a non-resident as a result of transfer of non-deliverable forward contracts. Again, here a small amendment has been made that income arising on the offshore derivative instruments, that is exempt. Again, for that, they have specified the conditions that the forward contracts is entered into between the non-resident with an offshore banking unit and is not entered through a permanent establishment in India. Then we have 10(4)(f), which is income by way of royalty or interest on account of lease of an aircraft by a unit of IFSC if the unit has commenced its operation on or before 31st March 24. Now, this is not only for aircraft, this has also been extended for a ship or a vessel. Okay. Then is 10(4)(g). 10(4)(g) is being introduced now. That is again income received by a non-resident from the portfolio of securities or financial products or funds managed by the offshore banking unit. That is also exempt. Okay. Then is 10(6), remuneration received by individuals who are not citizen of India. Remuneration received by officials of embassies of foreign citizens who are not citizen of India. That is again exempt. Then 10(6), which is their remuneration received for services rendered in India by a foreign national employed by a foreign enterprise. The foreign enterprise is not engaged in any business. The employee stay does not exceed 90 days. So that is something which is exempt over here. Okay. So this is something you should remember again for the MCQ question, that the remuneration received for the services rendered in India by a foreign national employed by a foreign enterprise. If the foreign enterprise is not engaged in any business, the employee stay is less than 90 days and the TDS is not required to be deducted, then that is exempt. Even what I said in the 10(6), that the remuneration received by individual who is not a citizen of India from the embassy of a foreign country, that is also exempt. Okay. That is clear. So if, let's say, for example, if there is a citizen of India, but resident of, let's say, USA, he was appointed as the, let's say, US embassy official. Now, if he is a citizen of India, then that will not be exempt. But let's say if he is citizen of USA, then in that case, that will be considered as exempt. So he should be a citizen of USA or citizen of any other country, but not India. Okay. Fine. Is it clear? Any doubt till now? Any question? So I'll show you the examples over here. Let's say Mr. A, citizen of India but resident of USA, was appointed in India as an employee of US enterprise. Such US enterprise is not engaged in any business activity. A's job requires him to visit every 25 days for reporting purpose. During the financial year, A earned remuneration of 10 lakh and his stay was 85 days. Further, US enterprise has not claimed any deduction of such remuneration. Now, he being an individual who is a citizen of India, such remuneration shall not be exempt. Okay. If A is a citizen of USA, then that remuneration will be exempt, provided that the US enterprise does not carry any business in India. Then salary received by a non-citizen for services in connection with the employment on foreign ship, that is exempt. Remuneration received by foreign government employees during their stay in India for training is exempt. Then we have 1023 FBC, income accruing or arising to or received by unit holder from a specified fund or on transfer of units in a specified fund. Again, that is something which is exempt. Okay. So that is something which is exempt, and the specified fund means that AIF, which is located in IFSC. Then sovereign wealth fund, again exempt under 1023 FE if it has the income in the nature of dividend, interest, or long-term capital gains. Okay. Then you have, so here the summary is given. Maybe you can just go through this particular summary, which is provided here. So 1023 FF, which is there, that is in respect of the sovereign wealth, 1023 FE, which is there, is in respect of sovereign wealth fund. There is another section 1023 FF, which exempts the capital gain, which is received by non-resident from a specified fund on account of share transfer of a company that resident in India. Then that is also exempt under the Income Tax Act. Okay. So all these are the exemptions which are given. You have to just go through this particular summary. Fine? Yes or no? Is it fine? Any doubt? Any questions? Any doubt? Purushottam, Kaushiki, yes, these are exemptions. I would not want to spend so much time on this because see, these are exemptions. There is nothing technical which I should explain over here. You can just read it and understand also. So see, we have to spend some time on these sections which are very, very important. Like if you see, we spend time on loyalties, FTS, because that is something which is important. Here, it is important, no doubt from the MCQ's perspective, but here it is self-explanatory. What should I explain in this particular case, right? That is the thing. So I've just given you a highlight very quickly. You have to just go through, like, let's say, for example, I'm talking about, let's say this 1023 FE, income of wholly owned subsidiary of Abu Dhabi Investment Authority. Now, what should I explain? Here, the eligible investment should be a business trust, AIF, domestic company, having minimum 75% investment. There is nothing to explain over here. So what should be explained in this particular case? Hence, we just went very fast. Okay. And Purushottam, it's not complex. It's something which is self-explanatory. You have to just remember what are the exemptions. That's it. Clear? Any doubt? Fine. Any questions? Any doubt? Okay. Fine. Now, next important part which is there is in terms of the presumptive taxation for the non-resident. Now, which is what I'll be discussing now. See, go through these particular exemptions. In case you're not able to understand, reach out and we'll see. These are very, very to the point. See, let's say, for example, I'm talking about penalty. Penalty is 10,000. I cannot explain anything on that point, right? So that is there, which is there. Okay. Kaushiki, no, this is not last class. We have even on DTAA. So we are going to spend some time in the next class also. It's very long chapter. Presumptive taxation for non-resident. So this we had not done while we were doing the PGBP. If you remember, we have not done this while we were doing PGBP. We have just done 44A, 44AA, 44B, 44 AD, all of those sections we had done. But we had not done this particular part, which is the presumptive income for the non-resident. For non-residents also, there is a presumptive taxation, which is there. which is what we are going to learn now. Again, this is something which is very simple, but you have to just remember this particular point. So first is section 44B. Section 44B, which is there, provides that this is applicable to the business of, I'm writing here the business, here I'm writing section. This is applicable on the business of operation of ships. Business of operation of ships, right? On account of carriage of passengers, goods, or livestock. Right? So this is on account of carriage. Now, what is the tax rate which is there? Or what is the presumptive income which is there? 7.5%. 7.5%. So 44B provides that 7.5% of amount paid or payable, whether in or out of India, amount paid or payable, whether in or out of India, on account of the carriage of goods, passengers, or livestock. On account of carriage of goods, passengers, or livestock. Fine. Secondly, amount received or deemed to be received. So paid or payable or amount received or deemed to be received in India by or on behalf of assessee on account of carriage of, again, passengers, on account of carriage of passengers, goods, or livestock. Is it fine? So 7.5% you have to take as this particular presumptive income. For 44AD, it was 50%, or for that matter, 8% or less was also allowed. Here, less is not allowed. Here, less is not allowed. There is another important section. Okay, before we move on to that, these charges will also include the demurrage or handling charges. So the amount paid or amount received will also include demurrage or handling charges. Demurrage or handling charges will also be included. Now, what do we understand by demurrage charges? Demurrage charges are paid for the usage of the container beyond the certain time which is given. So for certain time, you can use the containers in the ship freely, but after that, there are certain charges which are levied. So you have to include the demurrage charges or the handling charges will also be included in this amount paid or payable. Fine. So it will include the demurrage charges or handling charges as well. This is 7.5% the presumptive income. But No deductions will be allowed, no expenditure will be allowed, but you can be allowed the carry forward of losses. So you can write here, no expenditure allowed, but losses can be allowed. But carry forward of losses would be allowed, or brought forward losses will be allowed.
From Harsha PC.
Okay. Now there is one more section which is worth noting over here, which is section 172, which is also applicable for the shipping companies. Now, what is section 172, which is applicable for shipping company? So today we are only going to do shipping company. For the others, we will do it tomorrow or day after, okay? So, section 172, which is there, is for the occasional shipping business of non-resident. If you remember our very first class, which I'm sure you would not, income of previous year is charged or assessed to tax in the previous year. The exception to the rule of that the income of the previous year is charged to the tax in the next following assessment year. The very first exception to that was that the shipping business of non-resident. Section 172. That was the very first exception. You didn't remember, right? Right? That's why it's very important to revise. So, see what happens. There are some shipping companies which just come once. They are not very routine. So, therefore, there is always a fear that once they leave the port, they may not pay the taxes. So, therefore, section 172 has been developed for this occasional shipping business, that their income will be determined before they leave the port. Before they leave the port, their income will be determined. They can only leave the port only when the discharge certificate is given and only when they furnish a return of income. So 172 imposes an obligation on the master of ship to prepare and furnish to the AO a return of the amount paid or payable to the owner or charterer or any person on account of carriage before the departure from the port in India. So before the departure, this particular return has to be furnished. And the AO will make the assessment. So this 172 is a complete code in itself. 172 will provide for the computation of income. It is providing for the payment of taxes. It is providing for filing of return of income. It is also providing for assessment. It's a complete code. Section 172 is a complete code. So the shipmaster has to furnish return of income. Then the assessment will be made by the AO. The AO on receipt of the return will determine the tax payable. Right? That what is his income? And based on that, the AO will pass the assessment order within 9 months from the end of the financial year in which return is filed. AO to pass order within 9 months from financial year in which return is filed. And then the AO will give the grant of port clearance. On payment of taxes, the AO will grant the port clearance certificate. And this is an optional scheme. This is an optional scheme. The owner or the charterer has the option to claim before the expiry of the assessment year, relevant to the previous year in which the date of departure of the ship falls, that the assessment may be determined in accordance with the normal provision and not as per 172. So 172 will apply when the ship is leaving the port. But later on, it has an option that it can go as per the normal provisions. And if it goes as per the normal provision by filing the return of income, then in that particular case, this particular tax which is paid under 172, that will be considered as advance tax. That will be treated as advance tax. Fine. Now, what does the 172 provides? I told you in the first class also. It is 172 provides for same as 7.5%. So here also you have 7.5%, right? Your presumptive income. Here also you have 7.5% of amount paid or payable on account of carriage. On account of the carriage, right? Whether payable in India or outside. This shall be deemed to be the income accruing in India. This shall be deemed to be the income accruing in India. Are we clear? Now, even this will include demurrage and handling charges. When this amount will include the demurrage and handling charges. So under 172, your 7.5% of the amount paid or payable on the account of carriage of passengers, livestock, mail or goods is covered. But the tax rate here will be tax at the rate of 40% as applicable to foreign company. Here the tax rate will be 40% plus surcharge in cess. Are we clear? Fine. Also, year 234B, C, all of that will be applicable. Year 234B, C, everything will be applicable. Okay. So that is remaining the same. Okay. Are we clear? So 44B is a presumptive provision. You are not allowed any deductions. Any expenditure is allowed. No expenditure is allowed. And this shall be deemed to be the profit and gains of business. Whereas under 172, again 7.5% of amount paid or payable is considered. That shall be deemed to be the income. And on that you have to pay the 40% tax. Are we clear? So this is how the entire scheme functions. If next year, before the assessment year, you decide to go for 44B, this will be considered as the advance tax. Fine. Any doubt? Any question? Any doubt? Any question? Fine. So will you revise this before the next class? Is it 7.5% of amount paid? It's amount paid and not received here in 172. Okay. There is a question which is there in module on 44B, which you have to solve. And one more question I'll give you in the next class on this. Fine. Also under 172, you are not allowed the carry forward and set off of losses, which you are allowed under 44B. 44B, you are also allowed the deductions, but here under 172, you are not allowed the Chapter 6A deductions. Okay. So this 7.5% is considered as the final income. You can just write it over here. No Chapter 6A or brought forward losses for 172. Okay. Shall we close the session? Kaushiki, 7.5% of amount paid under this thing, 172. Yes. Any doubt before we close the session? I'll give you one sum so that you will understand this 44B completely in the next class. Okay. Yes. So let's close the session. Thank you so much. In case you do not have any doubts, we can just close the session. See you in the next class, but till then, just revise everything and come. Fine.